Well, hi there, Andrew Bell with you once again, and great to be here. Some great, interesting news to share with you this week, covering a few topics. There's been this whole question about the state of the market and whether all the strong price rises over recent years are sustainable, or indeed whether they've been creating a risk situation to the market. There are some suggestions that in markets such as Sydney and Melbourne that they could be in for a strong price correction. There's some more research from CoreLogic on this. The national average home loan application is showing that the loan to valuation ratio across Australia is 74.3%, or 1.7% higher than the 72.6% recorded in 2011. However, and significantly, it's much lower than the 78.9% that was recorded in 2013. The downward trend in the loan to valuation ratio across the country reflects the fact that homeowners are building equity in their properties as prices rise. Have a look at markets such as Sydney, where the dwelling values have increased by almost 95% since the beginning of 2009. People who own properties since that period of time have now created a lot of equity in their property. Their debt remains the same, but the value of their property has almost doubled. And this is a fine example of why so many people choose to invest in real estate. Now, my observation is that even if there was a price correction, those people who have owned properties for 2 or 3 years will have more than enough equity in their properties at present to absorb some price correction. Now, Tim Lawless, who heads up research at CoreLogic, said the more conservative loan to valuation ratio shows Australia has adopted a more prudent lending standard. He said regulators and policymakers should be congratulated. Now, this leads on to the second bit of news, and that is research from Macquarie Capital, where their veteran researcher, Rod Cornish, has been commenting on affordability, which is an index that combines prices, mortgage rates and incomes. Cornish did particularly focus on Sydney, where he said affordability has worsened, but not as bad as 2003 or even back in 1989. What he did say was housing affordability could in fact remain stretched for 2 or 3 years. He said that despite the stretched affordability does exist in some cities, the important interest rate trigger for a broad-based turn in the cycle is not even imminent. Now, Mr Cornish is confident that areas of high demand, such as the inner city, urban areas, properties close to the beach, and with lifestyle benefits, and where there's continued scarcity of quality property, sounds like the Gold Coast, that properties will continue to rise in value. The next market update is in relation to building approvals. I mentioned before that nationally 18% of approvals never get to construction, although I suspect currently those levels will even be higher. There's been concern about overbuilding in certain markets throughout Australia, so the latest news that building approvals fell by 8.7% in September will alleviate some concerns. Significant drop was in apartment approvals. In fact, housing went up 1.7%, but apartments, townhouses and semi-cottages were down 17.5% from August. Of course we want building construction as it's a major driver of our economy, but we don't want oversupply. The report states that forward-looking figures point a picture of activity coming off the boil. However, the already elevated past approvals and commencements are likely to keep activity in the residential sector strong until the year after next. This relieves those concerns. On screen now is the latest consumer sentiment graph and shows consumers have been more optimistic than pessimistic over each of the past 3 months. You can see the graph bounces around quite a bit, but we have somewhat of a more consistent period in recent months. Consistency in the optimistic zone is a perfect scenario. Some pretty good news across all 4 of those latest research pieces. Looking locally, November was a great sales month across our team, 100 plus million in sales. There's not a sector of the market that's not extremely active. The last to click in was the prestige part of our market. We're thrilled to be recording some really significant sales, with sales like 25 million, 15 million, 11 million, 10.9, 10.2, and quite a lot of sales between 5 and 10 million bracket. This is a significant number of sales in a very short time frame, and the best the prestige market has experienced for some 9 years. I'm just back from visiting our office in Guangzhou. Overseas investors are continuing to play a significant role in supporting sales, particularly in new developments, but also in the recovery of the prestige marketplace. This year alone, we've sold over 300 properties to overseas buyers, with a great proportion of those being buyers from China. Final point is the bookings to be part of our upcoming Event 2017 program are flying in. If you're thinking of selling, please do not miss this opportunity to be part of the biggest showcase of Gold Coast properties that occurs on an annual basis. Our contact details are on screen. If you want any additional information, we'd be thrilled to get back to you and provide that to you. Well, I'll be back in a fortnight's time and only a couple of weeks from Christmas. Stay safe, particularly on our roads throughout this really busy Christmas party season. See you in a fortnight.